take stock of what Asia is up to, because the SGX Nifty is indicating a downward tick of about almost 0.5%. We've got Michael Every on board with us. And Michael, this is not good news. The fact that Trump has directed the US Trade Representative to list out $200 billion worth of Chinese goods for a tariff.
Well, good news or bad news is in the eye of the beholder, I think. It's certainly not going to be well received by the financial markets, I think. And what we effectively see here is Trump taking the nuclear option on trade. Initially we only had 50 billion in tariffs. The widespread suspicion was that after China responded proportionately with exactly the same tariff back on the US, that Trump would escalate by 100. Actually, he's now gone to 200 and has said that if there's any further retaliation from China, it will be another 200, which would take us to 450 billion, which is 90% of China's exports to the US. So clearly, the US is going all in, and either we are going to see China blink and this gets resolved peacefully, or this is going to get very messy.
How much of this would impact, either ways, China's GDP slowdown and the transition to the economy becoming more domestic-led is the talk of the town, is the discussion that draws a lot of EM strategies. How much of this trade tension can impact and further peg China's growth, to slow further?
Well, growth is already slowing, as we saw from the recent numbers. Not that you can really trust many Chinese data to be an accurate representation of what's going on, but we know that it is slowing. This obviously would be a severe headwind if 90% of China's exports of around 500 billion to the US get walloped and suddenly see a much lower market share in the US. That's an additional headwind against them. It's not going to blow the economy over, largely because the domestic side of the Chinese economy is so much larger than it used to be. But one thing I have to clarify, this constant message we hear about China rotating to consumption is simply not true. It's not true. It's still an investment-led economy. It's still a government-led economy. And this is not an economy where Chinese consumers will step up and say, don't worry about the lack of exports. We'll just go out and buy more, as would be the case, say, in the US or in other developed economies. This is still an economy where instead the Chinese government will turn around and say, let's build another highway, another railway, another bridge to nowhere, and that will keep the economy going instead, which is all very fine in the short run, but it ends in a huge problem in the long run.
Joining in conversation. Now, we had Tata Steel management yesterday, and he too, was talking about tariff war. And he made a very interesting point and mentioned that because of this tariff war, the steel prices in US have gone up, and that take cares of the additional tariff which US is imposing for a country which is exporting to US. Do you think this rise in inflation because of US tariff war would slow down US faster than anticipated? And also, last time you were mentioning on our channel that how Fed probably seemed to be more optimistic than what market is, and bond yields are now seeing some correction at 2.88.
Well, on the first point, it's extremely complex because it's a very fast-moving situation. But I do think that was an interesting comment because it points to the fact that this is a very dynamic process rather than a static one. And when economists do their number crunching, it's usually always static models and presuming X, Y, therefore Z. But, the irony could well be that, yes, if steel prices in the US are forced up by those tariffs, suddenly everyone else looks cheaper, despite the fact there's 25% or 10% tariff, whether, steel or aluminium that you're talking about. At which point the question then becomes, do you get further tariffs? And does that squeeze prices higher again? It's, it's an interesting tail-chasing exercise that we're undertaking. And in terms of the 10-year bond yield, well, yes, when we were breaking through 3, everyone was talking about 3.5 and 4, and I said, let's hold 3 first for a while, shall we? And we haven't managed to hold 3. And while on one hand we do have, an inflationary dynamic from the cost push side due to these tariffs, one wonders if it's actually genuinely going to turn into a demand pull one, which would keep bond yields higher. And I very much question that assumption.
Right. Michael, what do you make of the fact that, because of the kind of dependence emerging market flows have due to passive instruments like ETFs, the kind of volatility that they infuse, because we're just reading the headlines about emerging market ETFs seeing outflows of close to $3 billion, mostly over a year. And that sort of pressure just accentuating a fall in the markets across the region.
Well, I think it's another good question. We've already established firmly this year something that many people have been saying for a long time and nobody wanted to listen to, which is that ETFs are just an accident waiting to happen. And they are. The only question is who they happen to and when. But the global, fundamental macro strategy backdrop, if we are going to see an escalating US-China trade standoff, is exactly the kind of headwind that's likely, not guaranteed, but likely to increase the risk of one of those accidents happening with ETFs in emerging markets.
Okay, Michael, thanks as always for joining in with your take on the weakness in Asia. Definitely feeling the heat from the fact that Trump is going to draw down a $200 billion worth of list of Chinese goods to slap a tariff on.